Thanks, James. Hi, my name's Will Lutton and I'm Head of Investment at Industrials REIT. I want to take you through the main functions of the investment team. So firstly, I'm going to look at what we buy, and then I want to talk you through our pipeline and how we go about generating the opportunities to support our investment requirements. Then I want to move on and look at the makeup of our recent acquisitions before taking a deeper dive into a couple of case studies, focusing on how we add value to our, due to our market positioning. On our valuations, I'm going to look at how these have moved over time. And finally, I want to talk about how I see the investment outlook as the well-publicised issues that we're all aware of start to bear down on pricing and deal volumes, and how we see Industrials REIT being positioned in this environment. We have a very straightforward investment requirement. It's very focused, which allows us to appraise opportunities quickly and accurately, utilising knowledge from our existing portfolio and leveraging the real-time data from our Industrials Hive platform, particularly for customer demand and rent information in specific locations. We can also quickly benchmark CapEx spend based on ongoing projects within the portfolio. We've always got a roofing, a cladding, or other major project which provides really good intelligence that I can feed into my asset underwrites. And then some of the other key points that we consider when appraising opportunities. Firstly, location. In and around densely populated areas. That's important for our customers because it will be near the pool of labour that is important for them and also the customers that they in turn serve. Rental growth and reversion, absolutely key to asset performance and generating the income return that's important to us as a business. When determining this, we can look at transactions on the estate, other nearby comparable property, but also increasingly, again, using our own knowledge from other assets we may own in the locality. And this can help us to determine where we think we can sustainably move rents to. Tenure, a preference for freehold, so that there are no additional complexities in the management of the estate and to avoid the leakage that can come from long leasehold ownerships. Income diversification and unit size. We like units between 1,000 and 10,000 square feet. This is where we think we can add most value using our platform. But we don't want 10 5,000 square foot units. We want a 1,000 square footer, a 2,000 square footer, a 4 and an 8, because this allows us to cover different tenant requirements and lease profiles. We also prefer that one tenant doesn't dominate the estate because we want diversification in the income stream. And if there's one tenant that makes up a material part of the estate, it can become quite binary when you're looking at it. And the diversification of this income stream is one of the reasons we like the asset class. Lot size, anything under £3 million is not a particularly efficient way of deploying capital. We've tended to find a sweet spot between £3 and £10 million, so above private investors, but perhaps below some of the institutional capital. But we can be flexible around this and have indeed bought assets up towards £20 million. And the incumbent owner, quite an important consideration, because what issues and opportunities does the incumbent present? Is there likely to be more reversion than normal? Are there going to be management issues? And has there been the appropriate capital investment into the buildings? Control of the environment, so that's the physical control of the environment. Can we achieve this? And that's really important for us so that we can maintain the estates to the standard we want and create an industrial identity on the assets that we own. And we're very focused on the ESG fundamentals, both for operational reasons, but CapEx requirements in our underwrite and the wider ESG reporting requirements that James has touched on already. We include an ESG checklist in all acquisitions, and some of those key components are flood risk, which clearly speaks for itself. We don't want any interruption to our tenants, but also creates other issues around insurance. Environmental survey, which we undertake for every acquisition. We look at the construction materials, whether there's asbestos or composite cladding. EPC ratings, again, something that's front and centre for everyone. And particularly relevant given the changes in the MEES legislation that Gerald Eve talked about earlier. And then finally, we look at the tenant activities, and we have a blacklist which includes things like arms manufacturer, chemical and fertiliser storage, the fur trade, and manufacture of tobacco. Now, of those points I've talked about, if there's breaches, it doesn't necessarily rule it out, but it means that we can business plan accordingly. So some examples of what we buy and what we don't. So a couple of photos up there to show the kind of estates we buy on the left, and perhaps more usefully an example of what we don't on the right. For those of you that have joined us on an investor site tour, hopefully you recognise the kind of estate on the left from what you encountered. It's arranged in a traditional terrace layout, and each unit has its own roller shutter door and parking or yard area immediately outside. Every unit is fit for purpose and generic in nature, which allows diversification of use, and you can also see the estate is well maintained. The other estate on the right, which we did not choose to buy, is a chopped up old factory and has compromised units, some without yards and with awkward access, but would still be classified as MLI. There's also some obsolete office accommodation, which is a major drag on performance. And our ability to accurately underwrite the assumed performance of an asset like this would be significantly lower than the more uniform estate on the left. There's also much greater downside risk. If units come back at lease expiry, break, or through tenant default, void periods are likely to be longer, rental growth prospects significantly diminished, and perhaps the biggest drag on performance would be the requirement for OPEX and CAPEX investment just to keep the units lettable, but without the significant income return on ERV we see when we invest in our core product. The other key consideration on this asset would be the likely ESG challenges it would present. Again, likely heavy CAPEX spend just to meet the EPC requirements up until 2030. This is the pipeline of acquisition opportunities since 2015 that we've considered. The bars show deal value and the line shows the number of deals. Whilst it fluctuates significantly, it does show that with the exception of the 2 quarters highlighted, being Brexit and the start of the COVID pandemic, the deal volumes tended to sit at between 250 and 750 million pounds per quarter, more than enough to satisfy our acquisition requirements, and supports our thesis that the national market of circa £60 billion remains fragmented and trades regularly. At any point in this pipeline, there's going to be different pots of buyers and sellers, but individual periods were often dominated by one such type, such as institutional capital, private equity-backed asset aggregators, or IRR traders. On the sell side, you've had profit takers as yields have moved in this period, and those who've built portfolios and are looking to sell out to crystallise a portfolio premium. And then you've got the forced sellers, such as funds facing redemptions, and we'll cover that in a little bit more detail later. You can see a drop in volumes in the most recent quarter, but this was from an all-time high in the previous quarter. So at present, it's moved back to the longer-term trend, but there's a suggestion this is probably going to slow down for the remainder of the year. What should be noted, though, that this is available deals, and certainly a number of the deals launched earlier in the year have failed to sell or are being retraded, whereas in a normal market, you'd expect the vast majority of deals to go through. And how do we generate this pipeline? So in the current climate, conversations are becoming increasingly selective, and direct vendor to potential purchaser conversations are common. Many of us in the senior management here today are cultivating relationships of this sort. Since 2017, 32 of our 54 transactions have been off-market or had limited marketing, equating to 60% of acquisitions. In some cases, we'll have had an agency broker. So to generate these deals and the on-market deals, we have a wide pipeline of a wide network of agency partners. Some of these you may know, and some you will not. And having such a wide network of both large national agencies and local and niche advisors is essential to deliver depth and breadth to our pipeline. One may deliver the deal from the aging private investor who they've known for 30 years, and the other the large corporate portfolio deal, and some, of course, will do both. The likes of Williford Asset Management, Ryden, CPP and B8 also market property on our behalf, so have a good working knowledge of our requirements. We've split these into regional, national and specialist brokers, and we've done business with every company on this screen in the last few years. The market is fragmented and remains so our agency partners reflect this, as they all deliver different types of deal. So from this, what have we bought? Since we acquired the original portfolio of 25 MLI assets in 2018, This has fluctuated as levels of pricing have changed over time, and our cash available for acquisitions has changed as we've moved through our sale program of legacy assets. We've taken an aggregation approach to our acquisitions, and we've only bought one portfolio of scale, which was the Pegasus portfolio from Hanstein in 2019 for £67 million. Other than that, we've only bought single estates or a couple of small sub-£20 million portfolios. And the reason for this has been the portfolio premium in existence over this period. And we saw far more value in identifying individual opportunities and growing the portfolio in this way. The other benefit of this approach is that many vendors tag on a bit of a poor quality tail to many portfolios as a way of exiting their worst assets. And this means that we don't inherit tricky assets that we have to work through and then sell and then incur the fees around that if those assets don't sit naturally in our business. And on Pegasus, we managed to cherry pick the assets that we wanted and dropped about £40 million, so 30% of assets that did not fit our investment criteria. The graph on the slide shows how pricing is developed on a quarterly basis, both in terms of capital value, pounds per square foot, and net initial yield. Yields broadly remained between 6 and 8% for most of the period, with some contraction towards 5% in the last year. Capital values have increased from £60 per square foot to £80 per square foot, but still sitting at around a 50% discount to replacement cost, which is something that Paul touched on earlier. And part of this capital value increase over the period will have been because there's rental growth on those properties. So even if yields remain static, capital values will have increased. We've acquired these assets from a wide range of vendors. This has changed through the market cycle and again shows how the fragmented nature of the market. Buying from different types of vendors has positives and negatives. For instance, we've acquired 22% of our portfolio from institutional investors. These assets will have proper leases and service charges in place, and these are tending to be sold because they're the smallest assets in their funds, and indeed the leases themselves contribute almost nothing to fund performance. We therefore see an opportunity to drive income through a focused asset management approach. At the other end of the scale would be the private investors and some of the more local property companies, where income may not have been documented properly, service charge and maintenance not run in a traditional manner. The opportunity here would be to bring a professionalism to the management of the estate and drive performance through that. And out of those 50 plus deals, I've just picked out a couple to illustrate where I believe our investment approach has added value. So the first on the left, the vendor was a UK property company, and this asset was openly marketed. We acquired it for £5.85 million, or 5.25% net initial yield, in March 2022. It had been under offer at £6.15 million, so £300,000 ahead, but the purchaser withdrew. We tracked the deal and made an approach when we knew there was issues. The key thing that we were aware of was that the vendor was under intense pressure to complete the sale by the financial year end. So we bid on that basis and committed to complete in 8 days. Our proactive monitoring of the deal, close relationships and strong advisory team allowed us to execute this acquisition and add a good quality asset to our portfolio at a discount to where it had originally been placed under offer. The second on the right was a UK institution, and it was from one of their open-ended retail funds. We paid £6.25 million, or 6.25% net initial yield, in December 2020. This was not openly marketed, but we knew the fund was facing redemptions and they had other assets for sale in the market. We made a direct approach. This was an asset that we knew well. So I just realised there's a switch in the graph. So I'm now talking on the presentation, so I'm talking about the one on the left now. But so this is an asset we knew well, as we were the freeholder of the wider estate, and we agreed a negotiated purchase price, and it became a contract race with the other ongoing sales across the UK, so that they could meet the liabilities required. And once they hit that rate, that level, they were just going to withdraw all other sales from the market. So the fact that we monitored the estate, could complete the acquisition quickly, and we'd made an off-market approach because we knew the vendor was under pressure, we managed to secure a high-quality estate that added marriage value to our existing holding. So, our competitive advantage on these deals and other acquisitions. We have a strict investment criteria which gives clarity in messaging to vendors and agents. We have board support. Who are fully aligned with our investment strategy. We're a specialist investor, so we know the occupational market and we know the other key inputs into any asset underwrite. We have strong market intelligence. We're plugged in with Industrials Hive and have a great network of agents and direct market contacts. We're an equity investor. We always bid on the basis of a cash purchase and then finance a tranche of assets in due course. Many will claim to be cash, but few truly are. And we have a strong team of trusted third-party advisors. This is really important. Our lawyers and building surveyors have been involved with the acquisition of just about every one of our 100+ estates. This means they understand our commercial priorities. We have a streamlined process because we're a specialist, both internally and externally, that allows us to execute acquisitions quickly. Because the variables in multi-let are fairly limited, we can streamline this process and replicate many elements on multiple transactions. And we have a reputation for deliverability. Over the last 5 years, across more than 50 individual acquisitions, we've created a strong reputation in the investment market as an investor who knows what they're doing, acts professionally and commercially, and can complete transactions in line with the promises that they made. So moving on to our valuations and the cost of debt. We have our portfolio independently valued every 6 months by Jones Lang LaSalle. Valuation by its nature tends to be a fairly backward-looking view on values, as it is a transactional, evidence-based approach. It's also important to note that it's an aggregation of individual asset values, ignoring any portfolio premium, which is a concept I've touched on already. The graph on the slide shows our portfolio valuation net initial yield over time since March 2019, compressing from a high of 6.7% in March 20 to 5.5% in March 22. We've overlaid the all-in cost of debt for propcos, which is a matrix that James used in his previous presentation. The arbitrage between the two in 2019 and 2020 was around 400 basis points, but we view these valuations as conservative, so the true arbitrage was probably closer to 200 or 300 basis points, as debt costs rose and yields compressed due to the weight of capital seeking industrial exposure, due to the strong occupational fundamentals around demand and supply, and the challenges in other core sectors such as retail and offices. This arbitrage fell to 200 basis points in September 21, and by March was just about non-existent. Clearly, the all-in cost of debt has risen steeply, and this shows the figure to September of this year, but could now be closer to 7%. We do not necessarily think that this 200 to 400 basis point arbitrage will exist in future. Indeed, according to MSCI, in the 10 years between 1996 and 2006, there was an average arbitrage of only 150 basis points. So what have we seen in the wider investment market so far in 22? And with thanks to Gerald Eve, not just because they're in the room, but their industrial and particular MLI-focused research is the best in the market. And I'm sure that many of you will have seen how we reference it in our annual report. This data relates to the period up until the end of August 22, and clearly since then there have been further changes. I've just inserted a quote from a recent report that I think is just worth considering. Outward yield shift in the direct market has been significant. Prime industrial yields, after typically softening around 50 basis points in Q2, are estimated to have moved out a further 100 basis points in Q3, in the largest quarterly shift, certainly since the global financial crisis, and potentially on record. So taking these graphs in turn, the graph in the top right shows UK all property investment volumes quarterly since 2017. Whilst what this economic turbulence has done initially is significantly depressed transaction volumes, with Q3 22 sitting at 50% of the average volume we've seen in the previous 7 quarters back to Q4 2020 as we came out of the first COVID lockdown. This is broadly replicated in the MLI specific data, with the last quarter having the lowest volume since Q2 2020. And anecdotally, I see this continuing into Q4. There is limited real distress in the market at present. Some funds have suffered redemptions, but it was announced earlier this week that a number of them, including Schroders, BlackRock and Threadneedle, have gated, as they could not meet their redemption requirements. So even the pressure on them to sell has diminished for the short term. And there are not many owners of property currently under significant pressure to liquidate assets. Many investors are sitting on their hands to see how things develop. And from personal experience over the last weeks and months, it's pretty difficult to underwrite deals given the volatility in the market, especially if any debt is assumed, and that's even with our relatively low LTV. So we're much less sensitive to this than many of our peers. And for those investors comfortable to progress, they're looking for bargains, which means there's a disconnect on pricing between buyers and sellers. Evidence is limited, but the Gerald Eve data on the graph in the bottom right, which I'm seeing replicated in the market, shows that yields are coming in, and this has been fairly even across the regions. So what's going to happen next? Over the summer, pricing changes, in my view, were fundamentally mathematical, i.e. that we're tracking changes to the debt market. I think that over the last few weeks, this has moved on again, and other headwinds are being priced in. So inflation, availability of debt, recession weighing on occupational performance, and availability of capital. So further yield softening to come, perhaps, especially if more owners suffer distress as they enter refinancings. And where does this leave us? So at the moment, we've paused our acquisitions, but we believe that we're well positioned as a business. We have a prudent debt strategy that James has already talked through, and a low LTV compared with many of our competitors, such as those private equity-backed investors. And we continue to see strong occupational performance that Simon will delve into later today. We have a clear strategy, and our investment discipline means that our existing portfolio is well positioned to show income and valuation resilience. When we look to start investing again, there's likely to be a reduced pool of buyers, and our income-focused approach may be advantageous and allow us to identify attractive, accretive, unlevered returns. Thanks. Any questions on that stuff?
Thanks. Just a quick one on the open-ended funds. I appreciate they've gated, and that effectively just buys them time, right? Surely that does mean that there is going to be some distress coming to the market, and I appreciate what you guys are saying in terms of debt costs. But do you think, basically, what's your view on that? Do you think there will be some more opportunities that come out of that because they know the cash redemptions are coming, right? Yeah,
I think what's changed is that over the last month or so, some of those funds were seeking to liquidate assets to match those redemption liabilities, and there have been a number of sales that have come out of those funds. What the gating does, as you say, just gives them time. So I think one of them was only saying they were going to meet their liabilities by the middle of 2023. So there'll be much more control around the sale of those assets rather than the kind of the fire sale that has been happening over the last month or so. So I think, yes, good quality opportunities to come, but perhaps more in just more of a controlled way than we've seen in the short term.
Thanks.
Hi. So just maybe just to tag on to Max's question there, what are you looking for in terms of acquisition opportunities? At what point would you be pulling the trigger and saying, okay, now is the point where it's attractive to acquire some of these assets that are coming to the market? And I ask that in the context of what's happened to your own share price, what's happened to your own implied yields, and your own implied capital value per square foot.
Well, I guess on I'll maybe just touch on an individual deal, but we'll just be looking for an asset that can deliver returns that are accretive to our overall portfolio. So that's from my perspective is where we're going to start with.
Yeah, I agree with that. First and foremost, it has to tick the boxes in terms of delivering accretive returns. I think buying into a falling market is always tricky, and I think there is little incentive to buy into a rapidly falling market, and I think that's not going to change. So we're going to continue to monitor the market. I think at the moment, prices are coming out. This is what we've been talking about. Gerald Eve, 150 basis points. That's rapidly falling market. Quickest quarterly movement in yields on record. Definitely a rapidly falling market in that way. So we're not debunking that myth in any way, shape or form. The market is repricing, and I think we're going to continue to monitor that. It will obviously we're very in touch with where the cost of lending is. We've got a great pipeline, so we can see where the value is in the market. I think what you tend to see in a market like this is a greater variance in terms of the pricing of assets. When the market's functioning really, really well, you get great transparency. This asset is going to be worth roughly X, and you can price it within a quarter point. What we're seeing at the moment is that similar assets might be priced 20% apart in terms of their relative value. So we're looking for relative value, and we're looking to line that up with what we feel is as relative value in the longer term that works for our business. But I think it's at the moment, as James has already said, it's a time for prudence. It's a time for making sure that our balance sheet is strong, that we can endure and see through this period of volatility, so that we're in the best possible position to capitalise on the way out.
If I can also just add, if you look at our balance sheet, we've got a little bit of spare cash, but not a huge amount. We could buy 10 or 20 million or even 30 million potentially, but we'd have to draw down on that debt that James Wakeland referred to. We've got about 52 million of ability to draw down. But in reality, debt's not adding any value, and it's not accretive. It's actually going to take us backwards. So we wouldn't really want to do that for that reason, but we also wouldn't want to do that because I think this is a time where you've got to protect your balance sheet and not really rush into this market. And as Julian and quite a few others are saying, we don't really know where the bottom of this market is. But the reality is, what we do want to do is position ourselves, because ultimately we need to raise equity if we want to make some meaningful acquisitions. And all of you in the room are not going to give us equity until you're confident we've reached the bottom, I would think. Maybe not. But so that's really the issue. This is time to really batten down the hatches, be bulletproof, really run the operations as efficiently as we possibly can, make sure our the voids are stay the same, make sure we get as much rental growth, and really keep our balance sheet strong, go through this period, position ourselves to be one of those that people want to really back when the time comes.
You've mentioned before that your EPRA cost ratio is at about 40%, and that new acquisitions you're bringing on are at around 20%. How do you think of your spread between your net initial and equivalent yield in the current environment? Does that start to widen, or do you think that sort of moves in line?
So there's probably two elements to that question. I think there's the EPRA cost ratio one is more about scaling, and I think in reality, we need to grow the capital base to be able to access that scale efficiency, because we're currently pretty fully invested, as Paul said. I think when you're talking about the difference between your equivalent yield and your initial yield, for those people who are not sort of in the surveying language, your initial yield is your immediate return on day one income. Your equivalent yield is a weighted average between that and what you could lease it for in the open market today. So effectively your ERV yield. And it is important to know whether you're talking about initial yields or equivalent yields, and there isn't a particular consistent theme between reporting, I think, amongst investment companies. So it is important to know. Our equivalent yield is around 100 basis points, isn't it, north of our initial yield, so just north of 6.5%. Really what we're seeing is, like I said, it's a weighted average. As the market, as initial yields go up, equivalent yields go up, but the difference between our day one yield, our initial yield, and our reversionary yield, which is the other part, the far end of that, we believe that difference will come down if rental growth in the market isn't there. It will maintain if rental growth continues at around 5%. But ultimately, we'll unlock that growth over the next 3 to 4 years as we cycle through our leases. So, that's a question about how the market will perform. Will we be able to capture the inflation in our rents? Will growth maintain as Steve and Ben were forecasting? And how much growth we'll be able to see. So probably impossible to give you an answer, I'm afraid, Bjorn.
Is it time for one more?
Because it's you, but I think then we'll have a break.
Maybe just one for Will. Just wanting to get a sense, obviously sort of bearing in mind that it's maybe a difficult environment currently, But typically, sort of given that network that you outlined, how competitive is this bidding process for you, and how much kind of fighting do you have to do to get the assets that you want to get your hands on?
Yeah, so as you say, it's changed drastically over the summer. But prior to that, it was a competitive investment environment because of the really strong fundamentals. So you were looking at propcos, other listed businesses, and also some of those PE-backed investors that I touched on. But the property industry, by its nature, you can still pull various levers, and people are not always chasing top price. So that reputation of deliverability, being able to transact quickly, has allowed us to, in my view, kind of secure some really strong assets. But there's no doubt it's been competitive, and I think where you saw that most starkly was on the portfolios, which is something I mentioned a couple of times, and the reason for that is because it's just a really efficient way of deploying capital. So if you can put £100 million in the market, it doesn't take you 6-9 months to do so. And that's where that premium, which was 10%, even a little bit more, was coming from. There wasn't that frothiness when it came down to individual asset acquisitions. Now, that's a much more difficult question to answer. And given we've paused, we're not kind of in that bidding process so much. But whereas you might have expected a dozen bids, I think you'd be now at kind of 2 or 3. And as I said, those guys are really looking for bargains, and they have to identify where there's opportunities to secure that from vendors.
Sorry, can we take one more from Miranda?
Just got a question here actually from a client who can't log in there. He's just said there's a big elephant in the room here. The model demands scale, and you want to buy to leverage that scale, but you don't want to increase loan to value, and values are falling. This suggests you need to raise equity to buy. Would you consider doing this at a discount to reported NAV, i.e. before your NAV adjusts downwards for the yield expansion? Not sure you wanted that question, but...
No, that's a great question. It's what we think about all the time. I think the key point on that, everyone's fixated on our EPRA cost ratio and wants it to come down. But the good thing about having a very high EPRA cost ratio and having invested in this platform massively and having built this huge infrastructure is we're at our maximum peak of inefficiency in that sense, but we're still delivering a good return. We're still actually doing well, and if we stay in this steady state, we're fine. There's no need to get this down urgently because we're still delivering a good dividend, a good yield. We're still solid. There's nothing. We're not necessarily showing growth in dividends, although we think we could with rental growth and so on. But it's a safe, comfortable place to go, to continue in business. And actually bringing the EPRA cost ratio should be down, should be viewed as real upside rather